Hello everyone, my name is Jay Nicholds from Staples High School, and on my left is Brian Lee from Hopkins School. Our stock analysis is on a small insurance company, Arch Capital Group, ticker ACGL. After extensive research, we've chosen to issue a strong buy rating with a target price of $132.51, representing a 39.6% upside. Our investment thesis is based on four main pillars. It's diversified business segments, underwriting strength, undervaluation, and long-term growth. Arch Capital earns consistent and balanced revenue from insurance, reinsurance, and mortgage insurance. This makes them less vulnerable to cyclical swings in any segment. Arch Capital also has one of the strongest underwriting track records in the industry, especially in niche markets like aviation, marine, and construction. Their combined ratio is consistently below 90%, and even in turbulent years. And despite outstanding returns and operational performance, Arch Capital trades at a discount to own peers on price to earnings and price to book basis. Also, through organic expansion and strategic acquisitions, Arch Capital is scaling toward its global footprint and entering new high-growth segments like in the Asia Pacific region and Europe.
Just to give you a little overview of Arch Capital as a company, Arch Capital is headquartered in Bermuda and operates globally across the insurance, reinsurance, and mortgage insurance markets. It generated $17.4 billion in revenue in 2024 and employs over 5,800 people.
For evaluation, we use a discounted cash flow analysis to determine intrinsic value. Here's how we built it. We first projected unleveraged free cash flows from 2025 to 2029. Then we factored in a 6.52% weighted average cost of capital, which is based on a 10-year treasury yield as a risk-free rate, an equity beta of 0.81 from comparable insurers, a market risk premium of around 5.5%, and then we took into account Arch Capital's debt and equity structure. We used a conservative terminal growth rate of 2.5%, which aligned with the long-term GDP growth rates, and this analysis gave us a fair value of $132.51 per share, a near 40% upside from the current share price. Relative to peers like Chubb or Travelers, ACGL trades at just 10.5x forward earnings, well below peer averages of 13 to 15x, despite stronger historical growth and a better return on equity. Its 1.6x price to book ratio is also below its 10-year average of 1.8x, suggesting a long-term upside.
For ACGL's market position, their primary market is North America, where they're a top-tier player in property and casualty insurance, reinsurance, and mortgage insurance. In Europe and the UK, they're expanding in specialty lines and reinsurance. In Asia Pacific, they're gaining momentum via Arch LMI, their mortgage insurance subsidiary. Globally, ACGL has about a 1.27% market share, but because they focus on specialized, less commoditized markets, their performance consistently exceeds that of broader mass market insurers. From a Porter's 5 forces perspective, 5 means no threat and 1 means high threat. We rated a threat of new entrants a 5 due to high capital requirements and regulatory barriers. We rated bargaining power of buyers a 3, but reduced in niche lines where ACGL dominates. We rated bargaining power of suppliers like reinsurers or data providers a 4, given Arch's scale and diversification. We rated threat of substitutes a 4 because it's limited, especially in regulated insurance products. We rated competitive rivalry a 4, but Arch's underwriting excellence and specialization give it a durable edge.
Arch Capital's business model is designed for risk-adjusted profitability. They combine specialized underwriting, diversified income streams, and capital efficiency to create efficiency. They use specialized underwriting, focusing on complex, hard-to-price risks that require deep domain expertise to manage risk, while having diversified income streams, so losses in one segment can be offset by gains in another, also managing risk. They also have strong capital efficiency, maintaining an A+ credit rating and $23.5 billion capital to absorb losses from catastrophes and acquire new parts of other companies for their business. This strategy isn't just about growing fast, it's about growing smart. The combined ratio of 85%, which they have, even in a year with significant catastrophe events, shows just how effective their underwriting is.
So ACGL has 3 major areas that are driving its future growth. For starters, reinsurance growth. There's been a surge in demand for specialty and catastrophe reinsurance. ACGL saw a 40.9% year-over-year increase in gross premiums in Q1 of 2024 in this segment alone. Second, for acquisitions, the $450 million acquisition of Allianz MCE business in 2024 added $1.7 billion in premium volume and created a 14.6% year-over-year increase in Q3 premiums. This is a repeatable growth strategy that ACGL can perform to expand into more and more segments. Lastly, organic growth. From natural industry rate hikes to their ability to retain and grow client relationships to leveraging analytics and AI in underwriting, ACGL continues to scale organically.
From a financial performance standpoint, ACGL is also extremely strong. It has a return on equity of 20%, a net margin of 24.72%, a combined ratio of 85%, even after major disaster losses, a revenue compound annual growth rate of 10.6% over the last 5 years, with 28.86% year-over-year growth in 2024 alone.
For investment risk and mitigation, there are two big risks that investors need to consider before investing in ACGL. First is natural disasters. ACGL had a rough 2024, incurring $393 million in pre-tax losses due to Hurricanes Milton and Helene. ACGL is also exposed to wildfire-prone areas like California. To mitigate this, they set aside $450 to $550 million in reserves for wildfire claims. They adjusted pricing models to better reflect extreme weather risks. They also incorporated AI for predictive analysis and risk selection. Lastly, ACGL also has limits for catastrophic events by capping the maximum probable pre-tax loss from a severe event at 25%, which minimizes their losses. Secondly, Bermuda's new corporate tax. Starting in 2025, Bermuda will impose a 15% corporate tax, ending its long-standing tax-free era. This is a significant shift for ACGL, but they've been preparing. For starters, they created a $1.2 billion deferred tax asset to absorb impact over the next decade. They also have been actively managing capital allocation and earning guidance to minimize the long-term effect. Finally, given their global presence and strong margins, ACGL is still in position to maintain earnings growth despite this tax headwind.
Arch Capital is also forward-thinking in sustainability through environmental programs, social programs, and governance programs. Environmentally, they have pledged for net zero emissions by 2030 and have begun cutting underwriting for clients unless they transition to clean energy sources. Socially, they have DEI programs and over 12,000 employee volunteer hours through volunteer time off, which demonstrates strong community engagement. Meanwhile, for governance, they have transparent leadership and strong institutional backing from firms like Vanguard and BlackRock, who emphasize governance.
For the industry overview, the insurance industry as a whole has a strong outlook with a 6 to 7% expected continual annual growth rate. To dive into the specifics, the specialty insurance has strong growth prospects with a projected continual annual growth rate of 11% for the next 8 years, or 2024 to 2032. Or double their value from $108 billion to $280 billion in the market. Next is the reinsurance market, which also has strong growth prospects, with estimates finding that the reinsurance market will go from a valuation to $711 billion to $2 trillion in 2034. So in 10 years, with a continual annual growth rate every year of 11%. Lastly is the mortgage insurance industry. It's the smallest of the three industries, and their continual annual growth rate is expected to be 6.2% until 2031, or $11.5 billion to $17.6 billion. On the tech front, Arch Capital is ahead of the curve. ACGL's underwriters use Calipa to automate low-value tasks so they can focus and save time for more complex tasks. Next, ACGL also uses Syrata to digitize and streamline risk intake and selection, which decreases their exposure to natural disasters. Lastly, AI is also improving customer service, cybersecurity, and overall operational efficiency.
To wrap up, we believe that Arch Capital is a strong buy at its current price of $96.14 due to the following reasons. Arch Capital combines a defensive business model with strong growth drivers, has world-class underwriting experience, is undervalued by every key metric we've reviewed, and is preparing for future challenges with effective risk mitigation strategies and innovation. In our view, this is a high-quality company, trading at a strong discount. We reaffirm our strong buy rating and a target price of $132.51, giving investors a 39.6% potential upside.
Thank you.